Hey folks, welcome back to our Forex trading course. We are in Forex Intermediate episode 10. And in today's lessons, we are going to learn about the stochastic and the moving average convergency divergency technical indicators. Therefore, in today's lesson, the objective are you'll be able to understand stochastic. You'll be able to know how to use stochastic to determine your entries and exits, understand moving average convergency divergency, which is called MACD, know how to use moving average convergency divergency to determine your entries and exits. We begin with the stochastic oscillator, and this is an oscillator indicator that helps traders determine when the market is overbought and oversold. It's similar to the RSI, whereby it scales between 0 to 100. However, with the stochastic, it is different from RSI in such that it has two lines, with one line moving ahead of the other, or one line moving faster than the other. The stochastic lines above 80, it means the market is overbought. That is from 80 to 100. It means that the market is overbought. Stochastic lines below 20, that is 20, between 20 and 0, it means the market is oversold. When the market is overbought, we look to sell, okay? And when the market is oversold, we look to buy. Therefore, you'll be looking. What it means here is that you'll be looking to buy if the stochastic lines are below 20. And therefore, you'll be looking with other confirmations, like maybe another indicator, or probably you'll be using candlesticks patterns just to ensure that you're taking a high probability trade. When the lines are above 80, that is anywhere from 80 to 100, it means that the market is overbought, and therefore you'll be looking for your selling entries, whereby you'll consider other aspects or other strategies or other indicators as well to ensure that you take a high probability trade. What I mean is that you don't just sell when the market hits the 80 mark, or you just don't buy when the market, when the stochastic hits the 20 mark, okay? You have to confirm with other indicators or maybe price action that indeed what you're taking is a high probability trade. The stochastic is it's best, or it's one of the best indicators. It's one of the best technical indicators when it comes to giving you high probability entries. Therefore, if you master or you ensure you know how the stochastic oscillator operates, you'll be able to have high probability chances of getting high probable entries. But one thing with the indicators, not only the stochastic, but all indicators, you need to always, again, check the trend. Remember, I've been insisting on this, that the trend is your friend, okay? So I'll be able to show you how to use a stochastic oscillator in the live market. But before we do in a demo account or in a demo market, but before we do that, let's look at the moving average convergency divergency, that is MACD. So this is an oscillator technical indicator, and it is used to identify moving averages indicating a new trend, whether it's bearish or bullish. So it has a moving average and histograms that form when the moving average is diverging and converging from the 0 line mark. Okay, I'll be able to show you that. Let me go to the chart and I'll be able. So when you come to the market, this is a demo account. Okay, this is a demo account. So when you come here, basically what you want, let's begin with the RS, with the stochastic, and you come here where we saw that this is where the indicators are in MT4. This is MT4 demo account. Then you come to the oscillator. Then you choose stochastic oscillator. Here it is. Okay. So we shall use the default settings. So once you do that, you see that this is now the stochastic. So it appears below here the market, the window below the market. So you can see this is the stochastic oscillator. It has two lines. You can see the red line and the one which is green. Okay. So basically, when you are using this indicator, it shows you instances of overbought or oversold, right? And we said that it ranges from 0 to 100. As you can see here, 0 to 100. However, we said that when it is between 20 and 0, it shows that the market is oversold, and therefore we look to buy. And when it is between 80 and 100, this region here, it shows that the market is overbought, okay? And therefore we look to buy, okay? Therefore, like you can see here now, let's look at this instance. So at this scenario, let's take a blue a line here. You can see where the lines are crossing each other, the two lines, where I've drawn the red line. Okay, the vertical red line. Here you can see the stochastic lines are crossing each other, okay? And at that point, when you go straight up, you'll see that the market was at its peak, okay? It was at its peak. And therefore, the oscillator, the stochastic oscillator, was between 100 and 80. So this showed that it was actually overbought. So at that point, the highest point, the oscillator value was 97.2682. Therefore, the market was overbought. And you can see after that, so the crossover that happened here, the crossing over of these moving averages is the confirmation to you. Once the moving average, once these two lines crosses over each other, it indicates now, it confirms to you and gives you a signal that the market is now selling. Okay, so you can enter your sell entry. And again, when you look here, there are some candlesticks patterns to confirm to you that indeed what you are seeing here, that the market might sell. Okay, and this is 4-hour time frame. Therefore, this movement from here to here, this is a good number of pips. So this is a pin bar, okay? And therefore it shows to you that, remember we said that when this happens, it indicates to you that the market is selling. Therefore you could have entered sell immediately after the formation of this candlestick pattern here, the pin bar, okay? So then you enter sell and you can see the market sold. So for you to be able to exit the market using the stochastic, now, when it comes in the 0 to 20 region, it shows that the market is oversold, and therefore you look to buy. So at this point, you can see when the stochastic lines crosses each other and points upward, now you know that the market is about to reverse, and therefore if you are in a sell position, you exit and look to take a buy position, okay? So in this scenario, you can see once they pointed up, the market bought, and still the market is buying. However, at this point where the market is at the moment, you can see the stochastic, they are between 80 and 100. Therefore, it tells you anytime a reversal is likely to happen. And therefore, once the crossover of these two lines happens and they point downwards, then it confirms to you a sell entry, okay? However, for a beginner, I said the trend is your friend. At times, it might be challenging to trade these retracements because you can see the market is in an upward trajectory in the 4-hour time frame, and this is a retracement, okay? Therefore, you want to be safe. So for you, you can be just buying the market. When it reaches, when it is in this level 0 to 200, just look for buys option. When it reaches 80 to 100, take your profits and wait for the market to retrace back to the 0 to between 0 to 20 level, okay? That's how you'll be able to trade safely in the market. Ensure that you are taking your trades in the direction of the trend as a beginner. But as a trader who is experienced, you can be able to know how to trade these retracements very well without any problem, okay? So next, let's look at or before we look at the MACD, let's basically look at another example. So you can see at this point, the stochastic was between what's above. It was between 80 and 100. Okay, it was between 80 and 100. And at this level, we said that the market is overbought, and therefore we look to sell. And when you look straight up, you'll see this is where the market was when the stochastic was at that region. And you can see the kind of candlesticks patterns forming here. We have dojis like the dragonfly, the gravestone doji, and you can see the market actually sold. Okay, and the moment the price reached 0 to 20, between 0 to 20, then you exit the market. Okay, you take your profit. Okay, so and then uh, um, if you look again backwards, you can see this was an uptrend. So for an uptrend, you could be just looking for your buys only. So at this level, when the stochastic is between 0 to 20, so you be looking at your buys at this point. You be taking, but you're buying at this point. That is what we call, when we're doing pure price action, it's what we say that you are buying the dips. Okay. So next, let's look at the MACD. So the MACD is an oscillator. So here it is. We just take the default setting, and with the MACD, you can see here it is below. We said that the MACD has a vertical line or a moving average, the one you can see in red, and also it has histogram. So you can see this histogram. However, I want you to note that there is a 0.0 region here. So we have like a line we can be able to draw uh, at that level. So we can just indicate, let's put the properties 0.00. Okay, so that it can match with our line. That is 0.00. So I want you to see that clearly so you can see it. So anytime this moving average goes below the histogram or below the 0.00 level, the market diverges. Okay, it diverges. Anytime it's coming near this 0.00 line or mark, it converges. Okay, and anytime it goes above, again, it diverges. So the reason why it's called moving average convergence divergence, MACD. Okay, because it converges and diverges away from the middle line, which is 0.00 line. Okay, so basically what I want you to note here is that once the market is at the 0.00 line, let's say at this point, okay, let's say at this point, and you see the market is, and you see the histograms are starting to form in the upward direction and increasing in volume or in size, you know that the market is buying, okay? And if you draw a line here, at this point when it started to converge, you can see this is the point, and the market was at this point. But if you draw this line on the stochastic, it means that in our stochastic, it has already given us a signal at this point when the stochastic lines crossed over each other. But now the MACD, it's a little bit late. Okay, so you'll have an entry, but somehow late with the MACD. So at this point, when you're using the MACD, it means your entry will be around this point. So you can take your trades once it confirms. But again, with the MACD, you need to be very careful. You need to be very careful. Don't use it as a single indicator to get entries. It is not that high probable, okay? So ensure that you combine with other indicators or maybe price action, okay? What the price is doing, like the candlesticks patterns, okay? Therefore, the reason why I said that the stochastic is the best of all the indicators that we are going to cover, because it has a confirmation by itself, okay? It has two lines. When they cross over, and they point upwards, you know that. And when they are in the region of 0 to 200 to 20, you know that the market is buying. When they cross over and point downwards, when they are in the region of between 80 to 100, you know that the market is going to sell, okay? Therefore, you look for your sell entries. With the MACD, let's look at an example here. For a sell example, you can see the moment the MACD started going below or diverging below the 0.0 line, the market was around this point, okay? It was around this point, okay? So that you can match. So it was around this point. And therefore, with the stochastic, it has already confirmed at this point. Therefore, the MACD is a little bit lagging, okay? But when it crossed over now, it shows to you that the market is selling, and you can see the market sold. The market sold all the way until somewhere here when the MACD crossed over again. So if you're in a sell entry, and now you see the, let's say you're in a sell entry here, the histogram are increasing in size, okay? The moment you see that they have started to decrease in size, when now the moving average is converging to the 0.00 line, you take your profit, because now it shows you that the market is about to reverse and go in the other direction, okay? If you had taken a buy entry here, and the histogram now starts reducing in size, it shows to you that the market is about to reverse or change direction. And therefore, you look to take your profits before the market comes back to your entry, okay? So that's how you use the MACD and the stochastic to take your entries and also to determine your exit. We are going to cover these in more details as we proceed, but for now, that is what you're supposed to know. And I encourage that you keep abreast with me. Ensure that you subscribe. You don't miss any video that I will upload, because once I'm done now teaching from basics to intermediate, I'll be taking a particular concept and discuss it in depth, okay? Therefore, ensure that you're subscribed so that you don't miss. Thank you so much for watching, and see you in the next video.